Yo, this is John Hope Bryant, and this is Money and Wealth on the iHeartRadio Black Effect Podcast Network. This is Money and Wealth with John Hope Bryant, my weekly ministry of hope. So, this is a trending topic. There's been lots of discussion about Red Lobster. Everybody knows Red Lobster. We go there, we hang. It's one of those places that everybody can relate to. I've been there, had decent meals there with my family. And folks are upset because it went bankrupt, it went bust. And folks want to blame private equity for that because it was tied to, they want to say that it was tied to an acquisition by a company. The company's name is Golden Gate Capital, just to be very specific. They're out of San Francisco area. Um, and they acquired that company around 2014 for $2.1 billion. And folks want to say, well, that's because of private equity. The fault that they went bust is because of private equity. And as a result of that, folks lost their jobs and vendors have lost their contracts and nobody has a place to go to get, affordable seafood or accessible seafood around the country, blah, blah, blah. A lot of my so-called liberal friends have come out, railing against private equity in this example. And my response to that is they're right. In this one example, they're absolutely right. Um, Private equity did not do a good job here. And specifically, Golden Gate Capital. And I'm going to explain what private equity is in this episode. So don't worry about it. I'll unpack, the what the heck, the what on private equity. We talk about these terms. No one ever explains it to you. I'm going to explain that. I'm going to explain a little bit about venture capital and other ways to access capital. Anyway, and the good and the bad, whether it's good and bad. So stay tuned. But in this particular example, it's a bad example. Um, and there a lot have been said about Golden Gate, or sorry, private Red Lobster doing this campaign that allowed you to buy a lot of food for a little bit of money, and its success drove the company out of business. No, that's not true. There was, I think, about $10 million worth of losses tied to that. They call that a loss leader in business, where you do something that may cost you $2, you sell it for $1.75 or $1.50 because you're trying to entice people to come do business with you. That's not enough to cause the company to go under. It's a contributing factor. The real thing that caused them to go under was a structure of this deal, and this gets into the primary discussion about private equity, which I'm going to get to. But this trending topic on Red Lobster is, yes, private equity did a bad job, in my view. Yes, they were short-term oriented. They were, I think, self-centered. I'm not going to say selfish, but self-centered. They structured this deal with an emphasis around financing structure almost alone, or at least primarily. And they so handicapped or handcuffed the operators of the Red Lobster chain that it was hard to maneuver. So one of the big things they did was a sell leaseback. They bought the company and used proceeds from selling the real estate underneath Red Lobster stores. And by the way, there's nothing wrong with this. McDonald's is in the real estate business. I'm in the real estate business. Real estate's the biggest business in the world. Let's not complain about that. But this was a restaurant company that should have had prioritized, the people, the food, the jobs, the efficient operations, the sustainability, and in this particular case, they wanted the money off the table right away, in my opinion. So they did a deal which they did a sell leaseback where they sold the real estate underneath Red Lobster to another company. I won't get into that, who and the what. It's less important. And when they did that, they also, it's been said that the real estate was sold and leased back at non economical terms. That's probably right. In other words, they leased it back above market. So if market is a dollar, they leased it back at $1.25 or $1.50 from the company they'd sold the real estate to. So they got some capital right up front, and it wasn't Red Lobster got the capital; the private equity firm got the capital. So if you're doing a deal and you want your money right up front from the deal, you don't believe in the deal. you're not really banking on the long term prospects of their success. You're trying to get in and you're trying to get out. And so that's, in my opinion, what happened here. That the private equity firm got in, they got their money out through a couple structural situations. The biggest one was this sale leaseback, and I think that was the downfall because that then meant that Red Lobster had no flexibility on lease payments. If you own the property, you're negotiating with yourself primarily. But a huge chunk of cash went to paying lease payments. In fact, the I just read that the location in Manhattan, a lot of these locations have been closed. The location in Manhattan is actually struggling because now the landlord there uh, wants to triple the rent of that particular location. I'm not sure if the landlord is the same company that owned all the real estate, or if it's different, but they want to triple the rent. But if you own that real estate, no one can triple your rent unless you're a masochist and wants to triple your own rent. There were other missteps. The company, there was another company involved in this that had bought a share into Red Lobster. This Asian seafood company with a lot of scale and a good reputation, actually a sketchy reputation, but at least they knew seafood, and that was supposed to have operational efficiency. And that didn't work. For a lot of reasons, that didn't work. So there's a lot of contributing factors. Interest rates went up, so the cost of debt became more expensive. The private equity firm, I think, tried to get the returns up front. That didn't work here. The sell leaseback deal, which works sometimes, did not work here at all. Um, and it saddled the company with a lot of debt that it couldn't pay back. And they tried to, you know, make a dollar out of 15 cents. And it didn't work. And if your outflow exceeds your inflow, then your overhead is your downfall. So I can go into much more detail, but I think you get it that yes, the critics here are correct. That the strategies of improving operations, improving efficiency as a result of this private equity firm getting involved with a company did not work here. In fact, I think the private equity firm took money off the table, off the front end, and that hurt the company. It was a short term gain versus a long term plan, which created long term pain for the company. And a good company, I think a decent company, went bust. And a lot of jobs got lost and all that kind of stuff. But so there was increased interest rate costs, increased labor costs, challenges with operations. All that's true. Promotions that didn't pay off. But the primary thing was this very, very the financial engineering was wrong, right? So sometimes things work, sometimes these don't. This one didn't work, in my opinion, and private equity should feel not good about this, and owe society, I don't know, an explanation, apology, a reinvestment. Somebody needs to reboot this brand. I think it's got a place in the marketplace, but this didn't work. Okay, now stay tuned because I'm going to actually unpack what all this stuff actually means and why or whether it's good or bad. Stay tuned. Hey, hey, this is John Hope Bryan, and this is Money and Wealth on the Black Effect Network, podcast network, and iHeartRadio. And I am about to unpack something that people walk around thinking they're dumb or stupid or they're ashamed because they hear all these phrases and terms and no one has explained it to them. There's no financial literacy. By the way, go get my best-selling book, Financial Literacy for All. Is number one still on Amazon in several categories. It came out number one nonfiction on both Publishers Weekly and USA Today national bestseller list. Number 12 overall on the USA Today list of all books, and it's still on the Amazon list. And I get constant feedback on it, and I want feedback from you after you buy it and read it. Everybody should have this on their kitchen table once a week as you open it up, dog-eared with notes and highlights and comments as you and your family unpack and repack money with yourselves in mind as you begin to build your own generational wealth and the business plan for your life and your family. So we are unpacking these terms that get thrown about that no one explains to you. And one of them I'm going to unpack today. Big one, private equity. And as a subset of that, yes, a subset, venture capital. And is it good or bad? Let's get into this. So, private equity is a form of investment that involves capital not listed on a public exchange. It consists of funds and investors that directly invest in private companies, um, or in private companies, or engage in buyouts of public companies, resulting in the delisting of public equity, which means in English, the company that was public then went private. It was public. You hear about companies going public. Some companies find it valuable to go from public to private, and that's done with private equity. And I'm gonna give you a shocker in a second about private equity. Here's a breakdown of key elements of how it works. Fund structure. Private equity firms raise funds from institutional investors mostly. I'm gonna get into this in a minute because there's a but and an and high net worth individuals. These funds are then used to invest in various companies. A PE, private equity fund, typically has a limited lifespan, around 10 years. There are some private equity firms that go on forever, but this, some firms have sort of a mission statement. Investment strategy. Buyouts are one example. I got into a bad example of a private equity deal, in my opinion, which was the acquisition of Red Lobster. I don't think they did a good job, nor it was that beneficial to society. Um, and so, buyouts are a primary example where PE firms buy a controlling interest in a company. The goal is to improve the company's performance and then to sell it at a profit. There's nothing wrong with that. If you own a gas station, ultimately you want to sell it for what? A profit. There's nothing wrong with that. You own a piece of real estate. You own a home. You want to sell it for a profit. You're not buying it to sell it at a loss. You want some stock. You want to sell it for a profit. There's nothing wrong with that on balance. Okay, so stay with me. Venture capital. Did I just say venture capital? Yes, venture capital is a subset, hello, of private equity. Investors in a startup and early stage companies with high growth potential also often tap venture capitalists. So venture capital typically involves smaller amounts of money targeted toward a company in an early stage to help them get moving. But that is still private equity. Growth capital, investing in a more mature company that needs funding to expand or restructure operations, enter new markets, or finance significant acquisitions. I'm going to come back to this. Very important. There's a black example of this, a couple actually, I mentioned. Value creation. PE firms, private equity firms, PE stands for private equity, aim to create value by improving a company's performance, often through operational improvements, strategic redirection, cost reductions, uh, and yes, sometimes that means layoffs, and leveraging synergies. They may also change management teams and drive efficiency. Okay, now before I get further into this, you're saying, okay, John, help me out, man. I don't have all day. Is it good or is it bad? Okay, on balance, waiting for it. Ready? Ready? Is it good or is it bad? Are private equity firms good or bad? They are good. On balance, they are good. And so now there's uproar. John, what do you mean? You just said that this Red Lobster deal was a tragedy, a travesty. You agreed with the pundits and the critics of this who, don't like capitalism, free enterprise. Yeah, I do agree. It was a bad example. Let me tell you about a couple good examples. In fact, I'll give you several good examples, but I'm going to get personal first. Reginald Lewis. Um, and who is the Martin Luther King Jr. of Wall Street. He's the first black man to do $1 billion deal on Wall Street. Reginald Lewis uh, bought a company called Beatrice International, which was in uh, 30 countries. He was a lawyer and investment banker uh, who wanted to do a big deal. He couldn't access bank capital, and traditional forms of capital were not available to him. This is a deal that was $1 billion in the 80s. I mean, it would be 20, $30 billion today. Just an incredible amount of money. This guy had chutzpah coming out of his ears. Just, who do you think you are? Somebody would say. And people did say, who do you think you are? He thought he could buy this company. He thought that it was undervalued, that the parent company did not appreciate the value that was underneath it. He thought he could maximize its value. And so he went about the business of trying to acquire this company. And when he couldn't find traditional forms of capital, he went to a guy named Mike Milken, who's a friend of mine, who back then was at Lehman Brothers, I believe it was, and sort of a first cousin to private equity is junk bonds. And private equity are literally equity money from rich people and institutions. So it's capital. But bonds are a form of capital, but it's a long-term debt instrument, and it's a high yielding, which means it's expensive. So the deal really has to make sense, which meant that Reginald Lewis really was quite brilliant when what he did. So Michael Milken sort of went around all of Wall Street who said no to Reginald Lewis, and he did this deal anyway. He backed him with $1 billion worth of junk bonds, or not $1 billion worth, but a lot of it, of his $1 billion deal was high yield junk bonds, and it worked out. Reginald Lewis bought Beatrice International, and he went in and he did some great negotiations and had a great strategy after his acquisition of streamlining operations. Yes, that might have meant laying off people, closing offices. He improved profitability. He implemented cost cutting measures, sold off non core assets of the company, mean things that are not critical to the company's success, leveraged strong brand recognition for Beatrice products, and grew and then drove growth. And he exited that company. Or Beatrice exited with incredible profits for all involved in 1996 when it was sold, and everybody won, including his family. And there's a foundation in place. There's a museum in Baltimore that is, I think, self-funding. There's the family has a family office. I'll get to that in the what a family office is in another podcast episode. You all need to know what a family office is, and you need to get one when you build enough wealth. But he created generational wealth, and he hooked up a lot of people. You need to translate "hooked up," by the way, who are better off because Reginald Lewis was there, and because this deal worked. And he could not arguably have gotten it done without, at that time, Michael Milken. I believe my friend Henry Kravitz also helped at KKR, but it was primarily Michael Milken who got this done when everybody said no to Reginald Lewis. He had to go to alternative financing structures, and he was brilliant enough to make it work and to put the company and its long-term prospects first. He didn't take the money off the table right away. He did the deal. He waited several years before he started seeing benefits. That's the way this stuff should work when the priorities are straight. And another example of a deal that worked that involves an African American in private equity is a guy you might know named John Hope Bryant. Yes, I did a private equity deal. I did a private equity deal with the Promise Homes Company, and uh, and it was uh, it was in this particular case two individuals who were wealthy, Tony Rester and Michael Milken, or uh, sorry, sorry about that, Michael Arrighetti and Tony Rester. I had Michael Milken on the brain there for a minute. Who are principals of a company called Ares Management that has about $350 billion of money under assets under management. And individually, they invested in a business idea I had with myself, contributing, my involvement in equity and all that kind of stuff. And we grew that company from zero to 100 and it had $160 million of book value, but I sold it into a joint venture for $121 million Christmas Eve 2021. And I went through Taco Bell when the deal was closing, as I told Charlemagne, and I did an interview with him. You should go back and watch that interview. By the way, it's been got a lot of attention, and we covered a lot of ground in an hour and 5 minutes. So thank you, Charlemagne, for doing that. I heart long form interview. And this deal, when the deal closed, I got when the wire transfer went through. I was getting the number one with a hard shell taco supreme at Taco Bell. But this is an example of private equity, and I had to pay these guys back their money plus a return, and I'm thankful for that. And there was banks involved. I had to pay them back plus their interest, and that's cool. That works. Everybody worked out. We created economic opportunity, a new business model. In fact, if you look this up sort of on the dictionary of the web, if you ask artificial intelligence to give you a conclusion of how I did that deal, it says that John Hope Bryant's Promise Homes Company exemplifies a successful venture that combines social impact with sound business practices. The company's growth and success are attributed to strategic financing, private equity, effective partnerships in banks, effective partnerships, and a clear mission to address the affordable housing crisis while empowering communities. And I would also add to that, making sure I was driving returns. And it says here um, that uh, uh, as I went about this, that I secured initial capital to fund my acquisition strategy. That's funny. I'm talking about myself and reading about it. This funding came from a mix of private equity, impact investors, and strategic partnerships. The initial capital enabled the company to make large scale purchases of single family homes across various markets. Completely correct. And then I added financial literacy, financial coaching, made sure that the vendors, plumbers, heating, electrical, lighting, roofing, all these vendors were significantly people of color and women who were left out of the economic strata. That's not leaving out mainstream vendors. We still do business with them too, but to make sure there was a prioritization of access to people who don't normally get contracts and opportunities. And every year we've done about $3 to $4 million of contracting. Last time I checked, with minority vendors, that's significant. I mean, we got to a point where almost 55% of our examples were minority and women, and I think to this day it's still about half. That's a good thing. Those are two examples of venture capital, and I'm going to give you some more examples of good examples of venture capital. But now let me go back to explaining venture capital itself. So I talked about those are two examples of growth capital within venture capital investment strategies. So I talked about buyouts, venture capital, which is a subset of private equity. I talked about growth capital. I just gave you two examples that are African American. Then there's value creation. PE firms, private equity, aim to create value by improving a company's performance, often through operational improvements. There you go. Strategic redirection. Okay, so I'm just covering this again, so you see this ties into what Reggie Lewis did, ties into what I did in that firm. I've got many other ventures, but I gave you that one example. Uh, and I'm still allowed to talk about it. God bless Reginald Lewis. He died of a brain aneurysm, so he can't explain this to you, but luckily I can. I met his daughter, Christine. She's fantastic. So watch out for her, Christine Lewis. Okay, number four, exit strategies. The ultimate goal is to sell the investment at a profit. There's nothing wrong with a profit, right? It's good capitalism and bad capitalism. Good capitalism is where I benefit, you benefit more. Bad capitalism is where I benefit and you pay a price for it, right? At scale. So what we want is good capitalism and good capitalists. So you want to, even if you want to distribute money like a socialist, you've got to first collect it like a capitalist. Hello. So you need to make a profit. You need to be able to do well and do good at the same time. Um, that's what this podcast series is going to do over time. I want you to give this entire series to someone you love, people starting a family, people going to college, people wanting a second lease on life, people trying to figure out how to make their 9 to 5 pay off in a 5 to 9, a side hustle. How do you build wealth? You make money during the day. It's called making a living. You build wealth in your sleep. This podcast is going to help you do both with dignity, and so look at it as an educational platform that also happens to be a little entertaining and hopefully pretty cool. So exit strategy, making a profit by selling this thing. Initial public offerings, taking the company public and selling shares on the stock exchange. So now you have private equity. Now let me give you another example for those who are still cynics who are saying, John, you're just dealing with rich people. And Reginald Lewis was rich and he was dealing with rich people. Let me give you a real practical, like Homeboy Shopping Network example of private equity. Let me hold on, I'm getting too excited. IPOs, cover that. Initial public offerings, going public, trade sales, selling the company to another company in the same industry, secondary sales, selling the investment to another private equity firm or financial investor. Risk and rewards. PE investments can be highly lucrative, but also come with significant risks. They typically require a longer investment horizon and can be illiquid, means you can't access your cash compared to public market investments, going public or dealing with a public entity. I can buy and sell a share of Coca-Cola or whatever tomorrow, but you can't just buy and sell a share of private equity interest. Now, what's the Homeboy Shopping Network version of private equity? Ball players, professional athletes, entertainers who take private equity, their own money from this contract at the NBA. Go back and listen to my podcast I did just recently on professional players going bust at scale. A few of them succeeding, but most of them going bust. 70% of professional athletes on average go bankrupt or have significant financial travails 5 years after retirement because they confuse making money with building wealth. They think that making money, like my dad thought, was actually that cash flow is profit. It's not. And they thought that money will last forever. It won't. And they were not financially literate. And that ultimately, financial literacy is a civil rights issue of this generation, which is why you've got to buy and read my book, Financial Literacy for All. My sixth book, but arguably, I'm being told these days by those who've read it, Ambassador Andrew Young, Bishop T.D. Jakes, Doug McMillan, the CEO of Walmart, who did the forward, and others, that it's really critical for today's society. So ball players are private equity. They're taking this contract, 100 million, 20 million, $50 million contract, right? And they're taking some of that money and giving it to Pookie them, or Boo Boo, or JoJo. Or, I'm joking, but we all have a JoJo in our family. And they're letting them fund to start a restaurant or open a club. I was about to say something else. You could probably imagine what I was about to say. Or to start a barbershop or whatever, right? Some idea they had. And if your cousin or your friend comes to you and you say, and they want $30,000 of your money, they're asking you for private equity. Private equity. Private is yours. Equity, your money to start a business. And if you say, "Where's the business plan?" and they say, "What's that?" Run. Run for the hills. Like that thing is not going to work out well most time, 9 times out of 10 it's going to be a disaster. And then they're going to blame you. They're going to blame you for asking for your money back. And yes, hang around 9 broke people, you be the 10th. But I wanted to connect those dots for you, that the money that professional athletes and entertainers use to fund neighborhood projects, community projects that are for profit with people they love, whether it's 10,000, 30,000, 300,000, 3 million, or 40 million, all these examples I put in my last podcast on why athletes go broke. Those are examples of private equity at the community level. So we need to get private equity from the streets to the suites. We need to make sure we're bank qualified. I did a piece with my brother Ti that's on his podcast series. I think it's called Expeditiously. You should go check it out, and it's got a lot of views online where I discuss non-recourse and recourse debt. Recourse debt. This is not now. This is different now. Debt, by the way, debt and equity are both forms of capital. I'm trying to cover a lot of ground here. Please excuse me. Debt and equity, so a loan and money you own, are both versions of capital. Private equity, whether it's in the streets or the suites, are still both versions of private equity. It's private equity. It's money that I have, or money that an institution, a pension fund or whatever might have, or money that a wealthy high net worth individual, a billionaire might have, that they want to put to work at higher than average returns. There's nothing wrong with that, as long as you do it where you're doing well and doing good at the same time. You can have winners and losers. Here's some examples, some good examples of private equity. I really need some feedback on this segment because I'm covering a lot of ground in a deep topic in a short period of time. So I need to know from you whether this worked and whether the light is going on with you, right? But so if you can be a private equity investor, you can have a private equity firm, somebody watching this or listening to this, with making $1,000 investments, making a $500 investment, making a $50,000, $100,000 investment, private equity. So somebody gets a bank loan, that's debt, and then they come to you because they don't have the equity, and then they might get. By the way, crowdfunding is another form of securing maybe private equity. So I just want to get your mind open that it's not just these quote rich people doing private equity. Ball players do private equity. Professional athletes, somebody from your neighborhood can do. You can do private equity. I've done private equity. I just gave you an example, just one example. Okay, here's some good examples at the corporate level of private equity. You always hear about the bad ones. And these created jobs, just to be clear, created jobs, sustained jobs, and created jobs for the cynic who say, "Yeah, John, but." Bain Capital and Dunkin' Brands. In 2006, Bain Capital, along with Carlyle Group and Thomas H. Lee Partners, acquired Dunkin' Brands, which includes Dunkin' Donuts and Baskin Robbins, for $2.4 billion. The private equity firms implemented various operational improvements and expanded the brand globally. In 2001, Dunkin' Brands went public. In 2012, the firm had sold most of their shares, realizing significant returns for their investment. And the companies today are prospering and have jobs and all that kind of stuff. Blackstone and Hilton Worldwide. Blackstone is a firm that you may not have heard of, but you've heard of Hilton. In 2007, Blackstone acquired Hilton Worldwide for 26 billion, despite the economic downturn in the midst when they did this deal, because the economic crisis happened in 2008, 2009. Blackstone improved Hilton's operations and expanded its hotel portfolio. Hilton went public in 2013. And by 2018, Blackstone had exited the investment, realizing a profit of $14 billion. Lots of money, yes, lots of risk. They could have lost it all, and they could have lost 26 billion. They made 14 billion. Kudos to them. And Hilton is thriving today. JPG Capital and J. Crew in 1997. JPG Capital acquired an 88% stake in J. Crew for $500 million. The PE firm revamped the company's image and product line, leading to a significant turnaround. J. Crew went public in 2006. And then, of course, the PE firm exited the investment. Bausch and Lombs was acquired by Warburg Pincus for 4.5 billion in 2007, and by 2013 was sold to Valiant Pharmaceuticals, now Bausch Health, for $8.7 billion. So you're seeing the bumps, right? In these examples, they also created what? Jobs. So it wasn't just the rich people who did well. Um, Bosch and Lomb and Duncan, Bain Capital and Duncan Brands, job creation, job sustainability, and job creation. Bosch and Lomb, Bain Capital's investment in Duncan Brands helped expand the company significantly, both domestically and internationally. This expansion led to the creation of numerous jobs in Dunkin' Donuts and Baskin Robbins stores, as well as their corporate offices. The company's growth under private equity ownership resulted in increased employment opportunities across its franchise network. Hilton Hotels, I shouldn't have to say much about this. You see it for yourself, but they're hiring, they're expanding, they're growing. So there you go there. J. Crew, um, uh, the investment period saw J. Crew expand its product lines and store locations, contributing to job creation in retail and corporate positions. Now you can't guarantee it's going to last forever, but this is a result of these particular deals, and the companies are out of it. They left. These companies are on their own. Bosch and Lomb, where they're all with new owners. Um, this also is an example where growth facilitated job retention and creation in manufacturing, research and development, and sales positions. The expansion and operational improvements under the PE firm helped maintain and grow the workforce. Uh, Now, are there bad examples of private equity firms buying somebody and just you have disaster? Absolutely. It's not just Red Lobster. Toys R Us. It breaks my heart 'cause I love Toys R Us. We all have a Toys R Us story growing up if you're from my generation. In 2005, a consortium of PE firms, including, well, hello, Bain Capital. So they had a good one, and here's a bad one. The company struggled with a heavy debt load from the buyout, despite efforts to turn the company around. Toys R Us filed bankruptcy in 2017, so 12 years later, and liquidated U.S. operations in 2018. This makes me sad. It resulted in a closure of hundreds of stores and the loss of thousands of jobs. Not good. I think Toys R Us was a decent, if not a really good company. Sears Holdings. We all know Sears. My God. I mean, who has a Sears layaway story, right? Um, Sears might have gone out of business anyway. It was just not well run and did not have a good business plan. But Sears was the Amazon of that time. It was a Walmart of that time. It was they should have how do you destroy this great brand? In fact, they did online before they were online. They had a Sears catalog, and they had mail order. You'd think that they'd be the first to market for online, but they just didn't pay attention. Just like today, you want to be Netflix, you don't want to be Blockbuster. Blockbuster was a company not subject to PA. This wasn't private equity failure. This was just bad management. They could have bought Netflix for a fraction of what it's worth today, like pennies on the dollar. Netflix came to them to be sold. They said, "Nah, nah, nah, I'm not interested." And we're Blockbuster. Arrogance. Ambassador Andrew Young says that men and women fail for three reasons: arrogance, pride, and greed. And this is an example of arrogance and pride. I don't know, well, arrogance, at least arrogance. And because they should have sold, they should have bought Netflix and then converted their business plan, but they didn't. And Blockbuster went out of business without PE's help, private equity's help, just because of bad decision making. Okay, so Sears, hedge fund manager Edward Lambert, ELS Investments acquired Sears and merged it with Kmart, another brand that was iconic that went poof in 2005. The outcome: the management strategy focused heavily on cost cutting and real estate sales. Hello, here we go again. Rather than investing in store upgrades or adapting to the changing retail environment. What did I just say? Sears filed for bankruptcy in 2018, leading to massive store closures and significant job losses. Um, Payless Shoes, 2012. Here's Golden Gate Capital again. Acquired Payless Shoes with a friend of mine. God rest his soul. Blum Capital did this deal also. As part of a larger deal involving collective brands. Payless filed for bankruptcy in 2017 and again in 2019. The company closed thousands of stores, resulting in significant job losses. The heavy debt load from the buyout was cited as a major factor in the company's financial troubles. Once again, a short-term mindset, in my opinion, and not focusing on, but focusing too much on the financing structure and not on operational excellence and how do I create a great brand, a great company, and get my money down the road when it's successful. Shopco um, is another example where they struggled under the weight of debt and operational issues. The company filed for bankruptcy in 2019 and liquidated stores and job losses. There's a bunch of examples, Deb shops, but there's when you look at this on balance, do you want uh, uh, different forms of capital that you can pull from, or do you just want to say, no, I'm good. We want private equity to go away. If you so then you have to say, okay, well, if private equity wasn't around, then where would business people get their money? Uh, Venture capital, which I told you is a form of private equity. That's one example. Angel investors, which is an individual version of a venture capital firm, which is private equity. Bank loans. Okay, this is not private equity. These are FDIC insured banks, but this is debt now. You got to make monthly payments. And you better make sure you know what you're doing because you won't have years to fail. You'll have months to fail, and banks will win. They'll get their money back. They'll own everything. So you don't have to worry about blaming a private equity firm that you can't find. You can blame a bank you can find, but it don't matter who you blame. Either you pay them or they're going to own the asset. So bank loans are another example, but you got to qualify for a bank loan, right? And if you're small enough, you can maybe get an SBA. We partner with the SBA at Operation Hope, get a small business. And a lot of big companies, by the way, came through the Small Business Administration. So this is a good thing. So this is an option. Um, Small companies becoming big companies through the SBA. So get a guarantee maybe from the bank through the SBA, which allows you to have more flexible qualification criteria in accessing a bank. Crowdfunding. Okay. This is, again, private equity. But it's suitable for startups and small businesses. Capital raises from a large number of individuals, typically through online platforms. Any of this stuff you guys want me to go deeper in, please put comments where you see this podcast or video, post it, and I read them. My team reads them. Black Effect teams read them, and we do respond. Government grants and subsidies often aims at specific sectors like technology, healthcare, or green energy. The great structure is non-repayable funds provided by government agencies. It helps foster innovation and support strategic industries. Research grants from the National Institute of Health is an example of a government grant, but it's not everybody can get these grants, right? You can't just you can't be uncredible. You have to be incredible. Actually, you have to have credibility in order to get this kind of money. Corporate venture capital. This is large companies that invest in startups relevant to their industry. But you got to do a lot of research and know the corporation and know what that and be able to access their venture capital division within that company and know the criteria. And you need relationship capital. You can't just be hanging around. Like I said, you hang around nine broke people, you'll be the 10th. You can't be caught talking drama, talking down capitalism if you want to know capitalists. You got to get to know not just poor people in your family, but rich people that are should be part of your extended family, because most of life is relationship capital. I'll do something on that relationship capital later. Retained earnings, that doesn't relate to most people, but that is basically a company reinvesting in itself. Initial public offerings, we talked about that, going public. So there's options to private equity. And if you don't like private equity, go do those things. Private equity should do more, by the way. They should be investing in back in community. They should have a philanthropic focus, in my opinion. They should have a social impact investment focus. They should have a fund or some mechanism for small businesses to access. I think they are. This is something I'm doing some more thinking on, but I think private equity firms should do more, given how they are benefiting from the legal structure and and sitting in the wealthiest country in the world, the biggest economy in the world, and accessing, um, in many cases, sources of funds like pension funds and other sources of funds that that derive their money from everyday people, and so that money should recycle, in my opinion. Once they've made their return, if they're doing well, they should also try to do good. Okay, so I've talked about a little bit about junk bonds, how um, uh, uh, Reginald Lewis got his deal done. I've talked a little bit about private equity, how I got a deal done. I've talked about several bad examples of private equity in a company that I think is the poster child right now for not doing it right. And I won't repeat their name again. I'm not beating up on them, but just it's obvious. Okay. And I've talked about uh, uh, good examples and bad examples and job creation, and I think that you should educate yourself uh, on on how this system works and how you can be a part of it and not just criticize it, because this is the world. We live in a free enterprise democracy, and I want you to be a player in free enterprise. That's why I'm doing this series to help you come up from nothing. That's my last book before this one, Up From Nothing. Okay, so this is John O'Brien, and this is the Black Effect Network and podcast series on iHeart Radio, and we just unpacked private equity and a little bit of venture capital and a little bit of some other stuff, and yeah, you're smarter, and now you can go do some deals, even if it's a homeboy shopping network version of venture capital, or which is crowdfunding, or private equity, which is our money in our pockets. We can all make a profit. You can invest in your local gas station or buy two or three local barbershops or whatever with private equity, your money, a few other friends' money in a limited liability corporation partnership. I talked about that in one of my other earlier podcasts. And if you're putting in a dollar, you want to make sure, again, risk reward. If you're putting in a dollar, I think you should want to have $2 in return. You putting in a dollar, and 3 to 5 years later, you want to make sure you're making $2 in that $1. And the company that you're investing in should be making $5, right? Otherwise, why are they doing it? Right? You're not just doing it do somebody's hair or sell products. You're doing it to make a profit. I'm gonna cover businesses in our neighborhood too, like weave stores and hair weave stores and barbershops. I'm gonna unpack all that so you understand how people are making money. Some doing it honorably, some doing it not so honorably, and you make your own decision about how you want to play and how you want to do your life. John O'Brien, this is the Black Effect Podcast Network. This is Money and Wealth, and this is making you smart, sexy again. Buy the book, Financial Literacy for All.